Welcome to Tech Talk Tuesday. There were some important things that happened last week in the stock market that we will talk about today. It's Monday, December 11th, 2023. My name is Karla, and with me today is your favorite CMT, David Blake. David, how are you doing this morning?
Well, thank you.
Great. Well, let's jump right into it by taking a look at last week's stock market activity and what's ahead.
All right. Well, we're on the major averages are on a 6-week win streak, one of the longest they've had, I think, since 2021, November 2021, I believe. So, but anyway, we started out a little slow last week, and that was partially due to Fed Chairman Jerome Powell and his speech over the weekend, more or less re-emphasizing that rate cuts in March were probably a little bit premature. The market's a little excited about trying to start get inflation down and also to see the yields start to move lower, which could, will help boost the economy and also stocks. So we ended up coming down. I think we're down about Dow and S&P 500. I think we're down the first 3 days of the week. Nothing big. The NASDAQ was a little bit more mixed in that thing, but then starting on Thursday, we started to get a little bit of jobs data coming out. We had the ADP employment report was a little bit less than what they expected. And that started to get people talking about, maybe the jobs are going to start falling off the cliff and we could go into a recession. And that pulled the market down a little bit. But we did also have on Thursday, where we came out where we had a big jump in actually the big cap technology stocks again. They've been kind of hesitating a little bit as we get a rotation into the more cyclical and stocks like the financials and that type of thing, healthcare that we've been talking about. Part of that was due to Advanced Micro Devices came out with a new chip to rival NVIDIA. The stock was up about 10%, and then Alphabet or Google came out their Gemini program. They just made another announcement, which they was a little bit more ambitious than what some people thought after it jumped up about 5 or 6%. Then they kind of sold that off as the week was ending on the Alphabet. Semiconductors were strong. In fact, here on Monday, they're strong again. Part of that's because of Broadcom. They came out with some good numbers, I believe, on Friday. And as we're speaking right now, we have the Philadelphia Semiconductor Index up about 2.3%. It's just taking out the highs from last August, which is good. We've been waiting for it. Some of these indexes have stalled around that July high period where we need to see it. That's the resistance for that, and the NASDAQ and some of these, and the fact that we can see the semis jump above that today, and the NASDAQ still struggling, but we do have the S&P 500 and the Dow trading above that also, which probably opens the door for a move possibly to the old highs we had back in January 22. But anyway, the yields did tick lower on Friday. We had the government's employment data came in. And that was kind of a little bit more of a Goldilocks number. It wasn't too high, it wasn't too strong, and that kind of reignited the investors that are looking for that soft landing type of scenario. So that was good. The market it was able to reclaim, move to the positive side for the week. And again, all the big ones ended up for six straight weeks, which was strong. Now, we did see some of the rate-sensitive industries like home construction outperform. In fact, the home construction ETF, it's ITB, was up 4.4% last week. That hit a new all-time high. You're seeing several of the indexes like Pulte Homes and Toll Brothers and some of those Meritage Homes, that type of stock, break out to new highs with this as rates come down. They expect more demand for housing. That's good for that.
Okay, so clearly big cap technology was leading the way. Which other market sectors were leading the market and which sectors were the biggest laggers?
As far as the market sectors went last week, because of the little pickup late in the week with the big caps techs, we had communication services, which contains the Alphabet and Meta platforms. Consumer discretionary was strong. That was because of Amazon and some of the numbers that came out from the Black Friday and Cyber Monday numbers. They were all both up about 4 or 5%. So that benefited some of the stores. Costco made a new high last week, I believe. And then technology was also strong. And on the flip side of that, we had energy, materials, and consumer staples finishing in the red. Energy was down, I believe, for I think it was down for a seventh straight week. We had oil actually dip below $70 a barrel for a while. Then on Friday, it bounced back and it settled around 71.20. But again, we've had oil prices down for a seventh straight week. A lot of that is basically because the non-OPEC countries are pumping gas or oil as much as they can right now. And also, the United States is also producing a little bit more. So the OPEC plus meeting that they had, where they said they're going to cut production and keep production cuts longer. They made it voluntary, which obviously, if it's voluntary, the smaller countries are going to pump all they can. They don't expect to abide by that. So that's pulling oil prices down. And at the end, like I say, on Friday's gains, we actually eked out some small gains in the major averages. So that was good.
Now, on to my favorite question. What's the status of the technical condition of the market?
The technical condition last week was rather mixed. I mean, despite the fact that we did finish higher, we've been talking about the overbought condition of the market for several weeks. I mean, you have six straight weeks of gains. You're going to be overbought, and we're overbought by several measures.
We are definitely in an overbought territory. What are some of the technical indicators that you use to determine this overbought condition?
Stochastics are up here in the 90s. I believe on the Dow Jones, if you look at the 14-day and 9-day RSI, they're as high as they've been, I think, since like 2018 or something like that. So yeah, the Dow Jones is 2018. That's the most overbought it's been according to the RSI. We actually even had the MarketEdge S&P short range oscillator, the SRO. That's probably the most reliable overbought oversold indicator. It closed Friday at 461, but that was after hitting 733 the week before, which was very overbought.
Yes, how I love the S&P oscillator. If you guys haven't heard of the S&P oscillator, you can learn more at sposcillator.com. That's S as in Sam, P as in Peter, oscillator.com, or at marketedge.com. It's definitely my favorite overbought oversold indicator, and it is so accurate. It's relied on by many industry professionals. And so basically, anything over a 4 is considered in overbought territory. But David, when it is, in an overbought territory like it is right now, and even higher, like it was the week prior, what are some of the things that we can expect for the market going forward?
So as we kind of churn sideways here on that oscillator, you will see some of that coming down. Still overbought, but the fact that the market's moving sideways to work off that condition is actually a plus. So you work off an overbought condition either by pulling back and turning lower and then come back up again, or you can go sideways as you rotate out of some of the big winners and move into the other stocks, which we've been talking about seeing. That rotation continues to go on. In fact, today, this Monday, you're seeing again the rotation is happening. We're seeing weakness in the big cap technology stocks. Microsoft is getting hit pretty good today, and Apple, that type of thing. But on the flip side, though, you are seeing semiconductors and even some of those secondary players outperform today, which is good. You can't dismiss technology altogether in this rotation and have the market continue to go higher. So it's good that we're getting this rotation today. The Dow Jones is up triple digits as we speak. NASDAQ is off about 50 or 60 points, and again, that's due to a handful of stocks. So I'm not too worried about that.
So, how are the resistance and or the support levels looking for the major averages right now?
We do have the S&P 500 and the Dow Jones already trading above the July highs from the summer. NASDAQ was bumping right up against that resistance level, as was the Philadelphia Semiconductor Index. Yeah, it's still bumping up around this. We need to see a good close above 14.4, maybe 14.450 on the NASDAQ for bell to ring that, okay, maybe we're going to make another run towards some old highs here. But till we get up above that level, let's just see how we go.
Okay, so let's talk about divergence. Are you seeing anything in the charts for the major indexes that you're keeping an eye on?
One thing I did bring up last week, and that was when you look at the weekly charts, on some of these indexes, you do see negative divergence show up a little bit earlier in these things, even though they're longer charts. What you do is you'll notice that some of the momentum indicators are not making higher highs as the indexes are, and that happened last week with the weekly charts on the Dow and the NASDAQ and the S&P 500. That's something we want to kind of watch this week. Now, if this market breaks out this week on the FOMC meeting that takes place tomorrow and Wednesday, then that negative divergence will probably be washed away, and we'll see the momentum indicators move to new highs as the indexes are, and that'll divert that negative resistance that we're seeing in that. So that's something to be aware of. If we don't, so let's just say we don't rally off of the FOMC meeting, then that was probably an indication that, or it's hinting that we could have a little bit more of a pullback on that. Now, I wasn't going to mention this right away, but the FOMC meeting tomorrow and Wednesday, we're expecting right now at this stage to see rates again remain unchanged. Previously, they were looking at March as a point where maybe we could start to see the Fed cut rates. I don't think I think that's kind of a rather ambitious, or as the Fed says, it's a little bit premature. So I think at this stage, we'll just go with that. But you don't want to see Fed Chair get too hawkish in his statements. I don't want him. He doesn't need to come out here and say, we're not going to cut rates till the latter half of 2024, that type of thing. He just needs to say that we'll be data dependent like we are, and at this stage with labor markets still strong, and at this stage of the CPI, which comes out tomorrow, with the inflation numbers kind of going sideways at this stage, I expect to see him just say what he's always been saying here for the last couple of meetings, and just continue that we're going to leave rates higher for longer until we see inflation continue to move lower. So that's something that we'll find out here over the next couple of days.
Okay, so I want to circle back a little bit here and check on the overall health of the stock market. How are we looking right now for the market breadth?
Underlying breadth last week was it was kind of weak, but then again, you were down for 3 days before you got a little bounce on Thursday and Friday. The AD lines were a little changed, but they both were up a little bit. And then we had more 52-week highs, outnumbered new lows on both the NASDAQ and the NYSE.
How's investor sentiment looking?
Sentiment continues to show investors a little bit too bullish. They're all in on this end of the year rally. I did mention that if by chance Fed Chair Powell filled a little bit of water on the fact that we could see lower rates, to the first half of next year, maybe the 6-week rally, which is nothing to just toss out. We could see it maybe disappoint the last week or two of the year. We'll have to see on that. Again, if he comes out and Powell is more dovish than anticipated, then we could see these indexes make another move in the end of the year. It's kind of with all the data that's already come out, we don't have much more data between now and the end of the year. So we kind of have the move that you would expect, and it's going to be basically what Powell says on Wednesday, whether or not we can continue this little rally that we've seen another 2 or 3 weeks. I kind of think with the overbought condition, we're more likely to see something go sideways here and just kind of churn back and forth going forward for a little bit in here. So that's about it. Again, what happens on tomorrow with the CPI and the FOMC meeting on Wednesday will pretty much influence where the market's going to go probably for the next week or two, and maybe even into year end. As I said, most of the economic data is out for the year, and I don't expect to see anything come in here and surprise the market at this stage.
Okay, well, speaking of the FOMC meeting, the last FOMC meeting, like you mentioned, is this week. And once again, it looks like the Federal Reserve will leave rates unchanged. If inflation continues to move lower, why does the market and also you not think that rate cuts can begin in March?
Yeah, it's possible it can, but historically, and I've been in this business for a long time, 35 years or so. You don't have you don't usually just step right down, continuously once you start seeing progress on inflation, and we still have to be careful that if if the Federal Reserve begins to start cutting rates, like also, we need to start cutting rates. That's probably not a good thing. And the reason being that they keep saying we want to leave rates at a more normalized rate. Some here around 3.5% would probably on the 10-year would probably be good for business going forward. If all of a sudden they start saying we've got to cut rates, it may be because all of a sudden, when you jack rates up, the yields up like we have over the last year and a half or so, it's going to affect the economy, which is what it's doing. Inflation's coming down. You're starting to see a little bit of bump up in the unemployment. Although last week when you had the unemployment rate go from 3.9 to 3.7, that was a little bit of a surprise. That's also what let us out on a Good Friday last week. This stage, going into that employment report, you had I think it was a 55% chance that we'd see a rate cut in March. That's what we're expecting. Okay, now with the stronger jobs data that came on Friday, that has dropped from 55% all the way down to 37.5% in just about a week and a half. So obviously, with the jobs conditions still staying strong, they're not the Fed's not going to be thinking about cutting rates. So if you're buying stocks because you're expecting a rate cut in March, I think you're going to be disappointed with that. And that's not a big thing. I mean, that may keep a little bit of a lid on the fact that we keep rates steady. May keep a little bit of a lid on some of the growth stocks and some of the big cap tech stocks, which is fine. I mean, you don't need to have them continually go up if this rotation stays strong. And as they've come off of their highs, we're seeing financials, we're seeing healthcare, we're seeing the industrials start to move higher, and they're holding up the broader market, which is a bullish thing. The fact that you have a handful of stocks leading the market higher, like we had in the summertime, that's not a good thing. And of course, once the rates, continue to tick a little higher than what they thought, then you saw those stocks begin to pull back, and that's what pulled the whole market down. At this rate, they can come off a little bit longer as rates stay higher for longer, and that will help out the bank stocks. That'll help out maybe some of the real estate stocks, some of the commodity stocks, that type of thing, and that will keep the market up. And it's a stronger market overall than it would have been than it was in July with the Magnificent Seven or whatever you call them. That was not a strong market. You also didn't have you had some negative divergence back then. Market was going up, and you had some negative advanced decline numbers. Generally, as technicians, we look at the advanced decline line as a leading indicator of market direction. It's one of the few that's a leading indicator. And it generally will, as long as it's going up, you should see the market continue to move up. When the market's moving up and the AD line starts to go down, that's telling you that it's a wobbly market. It's thinner market. You don't have the broad leadership that you want to see that can withstand some bumps in the road. When you only have 5 or 6 stocks leading the market, you get that bump in the road, 1 or 2 of them fall, then the whole market's going to fall down. Now, with the way things are going, it's going to take a bit of a shock to see this market pull back. And that would be in the form of also we start to see jobs fall off the cliff, or also we come in here and they're expecting to say maybe initial jobless claims at say 210,000, and all of a sudden comes in at like 290,000. Then you're going to see maybe the yields drop lower, but you're also going to see talk of maybe cutting rates for the wrong reason. That's to prevent a recession. So that's something to look at right now. As far as May, we have May going out now, where you have a 50% CME Fed Watch group. They now have a 50%. So it's kind of a coin toss for the May 1st meeting whether or not we would see the Fed cut rates. And and they're also divided on that. You have 22% thinking we can see a 0.5% cut, which I don't think is going to happen by any means. And then you also have 26% thinking that we'll still be leaving rates alone at that time. So at this stage, I think it's good. I think I don't think Powell wants to see the market go tumbling down. I think he'll be happy if he can just say that we're going to keep things rates higher for longer. It's premature to be considering a rate cut at this at this stage. The market should be fine as we continue to rotate and you start to see some of the more cyclical areas of the market continue to show leadership. That's good for the the broader market. And if that's the case, then I don't think you're going to see much more upside between now and the end of the year because there's not much data to come out. But I do think you could probably hold your own in here and you just kind of waver at the end. And then the last week is when the official Santa Claus rally starts. You'll get your hedge funds and all doing their window dressing where they want to have, where they shift what stocks they want to show on their end of the year formats that go out. That'll put a little more volatility into the market. But with no surprises, we should be fine. Again, keep an eye a little bit on the CPI tomorrow. That's the consumer price index. If we would see a tick up in the CPI where it's above what they're expecting, you could see rates go up. Maybe go up a little bit, which could slow things down or cause a little bit of a pullback. But don't forget, I mean, you've already seen in the 10-year, you've seen rates fall almost 7/8 of a percentage point. That's a big move in just a couple of weeks. So a little bit of uptick to that. Maybe if it goes back up to the 4.5%, which we've talked about several times on these things, that shouldn't cause a big slowdown. If you get a hotter number where it moves yields up above up around 455, 460, then maybe you can pull a little bit have more of a pullback on that, and that would probably disappoint people expecting the market to continue to go higher into the end of the year. But for right now, let's see what happens the next 2 days, and that should kind of set the stage for how the market's going to react from now to the end of the year.
Regarding the CTI change, so I know that we've had 6 straight weeks of gains, but what do you mean the market can't continue going higher? Because we were a -1 CTI last week, and now we are a -3 CTI as of this week. So can you maybe talk a little bit about how the CTI can go down, yet the markets continue to go up?
Well, yeah, the cycles, we're coming to the end of a lot of different cycles. They're coming to the longer term cycles are continuing to put downward pressure on the cycles. All of we did reset a lot of the shorter ones back in October, and they're exerting upward pressure on that. But when you that's rather than just consider the CTI alone, what we do a little bit different is we also throw in the momentum index and the sentiment index, just to measure how strong the shorter cycles are, or what how they're pushing against the longer term cycles. And in this case, the underlying momentum in the market is pretty much balancing out the downward pressure from the longer term cycles, and that's why it's keeping it in a neutral position. We were long until last not this last Friday, but about a week ago. And over that time period, I think the Dow was up. Okay, the Dow was up 2 points last week. We went to a neutral and it was up 2 points. So I think that was a pretty good call on that. We'll see how we go this week. Again, I mean, we could finish mixed with these cycles beginning to exert downward pressure as they're coming to the end of their cycles, and we'll have a reset sometime early 2024, which probably will begin another bull market. We'll see how that goes. This stage, we did reset the cycles at the end of October. They were due, and that short-term upward exertion on the market, it played out pretty well. But I think that the stage, you're probably the momentum and the longer term cycles are probably going to offset each other, and we'll probably just see some sideways action. But if again, if we see an uptick in the CPI tomorrow, and all of a sudden Powell decides he's going to be more bullish than what the market wants, then that'll take away some of the momentum. And because the cyclical trend index is negative, that would exert a little bit more downward pressure on the market. It's I guess look at this stage is kind of a coin toss. In other words, I wouldn't be chasing stocks in here trying to buy stuff up between now and the end of the year. The easy money's been made. You've been able to get probably some pretty nice gains here towards the end of the year. You're looking okay. I don't think that you need to be thinking I need to make more money between now and the end of the year. I think maybe you can celebrate the holiday and just kind of relax here and let it play out with sideways to or maybe just a little bit going down, and then we'll see what happens here going into the first of the year.
Well, I definitely agree. I do think that that move has played out to be the correct one with the CTI. And you also made the call for sideways action going into last week, and that is indeed what we saw. So great information as always, David. We are running out of time, so we will have to wrap up this week's MarketEdge Tech Talk Tuesday. David, thank you again, as always, for all the great information. And you guys can catch us again next week.
Sounds good, Carla. Thanks.